Promethean Inc., helping businesses get access to capital through credit. We also help people on the personal side. I am with my good friend, my confidant, my colleague, my mentor, my partner, Abigail Bridgeford of Genuine Property Solutions Real Estate, helping businesses get access to capital through all things real estate. And today is December 8th, the year of our Lord 2023. We are talking about our last installment. I'm going to be talking about major lending, which is the culmination of all the work that you've done in your building your business and personal credit together. So this is the culmination of that. I'm going to get started first. Welcome, welcome, welcome. For those of you who have typically seen us in the library on the second Sunday of every month in the Philadelphia Library and on South Walnut Street, we're coming to you via Zoom and YouTube simply because it is a way for us to accommodate more people, and we wanted to be cognizant of people enjoying the holidays, and so wanted to make this available to people as they travel and as they are in their homes preparing for the holidays. So let's jump in. I'm going to have a brief conversation about major lending. As you guys have seen, we have been talking about business credit for the last 5 months, and we're building a business credit profile so that, Abby, you can expand and grow your business through debt financing. Now, of course, there are 3 ways to expand your business financially. You can self-finance, which means you reinvest the revenues and profits back into your business, a great way. That's also called bootstrapping. You can find an investor and do an equity investment, which says that you're going to give up certain control and percentage ownership of your company to another party or other parties in exchange for their financial investment. And then you can debt finance, and neither one is better than the other. All of them can be used to expand and grow, making your business what you desire it to be. Many people will use them in conjunction, 2 of the 3 or all 3 of. If you are deciding to do debt financing, though, you're going to want to build a substantial business credit profile. Most people know in this country that there is a process for building personal credit. So, Abby, you're aware that typically as a young person, or even as an old person, I started kind of old, Abby, because I wasn't aware of exactly how to go through the process. And so I didn't know that I should seek credit mentors. But the process goes, you start with secured credit cards, then you move to unsecured credit cards, then you move to small loans, then you move into auto loans, and finally into major loans like a mortgage. There is also a process on the business side, and we have talked about every part of that process. But let's go back to the personal side. Shavonda, let's talk about you don't have to come off mute, stay on mute, but I just want to use you for emphasis. So Shavonda, you as a young person, on the personal side, would get a secured credit card, but the secured credit card is not the goal. The secured credit card is what helps you be more likely to be approved for an unsecured credit card when you are in market for such. And that's not the goal. That is just the tool that you use to move you into an auto loan or a student loan or possibly a major personal loan, $10,000 or more. But most of us don't even have that as the goal, Abby. Most of us on the personal side, many of us on the personal side, are looking for housing. As you know, there are 3 basic human needs I don't care where you are in the world. I don't care what language you speak. I don't care what gender you are. I don't care what your height is. I don't care what your weight is. I don't care what your vision is. I don't care whether you have 20/20 vision or not. I don't care whether you have 10 toes or 13. All people on this planet have three basic needs: food, shelter, and clothing. In the personal credit space, typically the goal is that shelter piece, that home. And we're not just talking about buying a home for yourself. You may be talking about buying an investment home. You may be talking about getting into an apartment. Whatever you decide, everyone needs shelter. And in this country, in the United States, that is getting that access to that shelter is heavily dependent upon what your personal credit looks like. So those are the things that you're going to do to get to your goal of shelter on the personal side. Well, the ultimate goal on the business side may be to expand your business so that you can service more of the population with whatever products or services you have. And so we have been talking for the last 5 months how to build a business credit profile. We talked for the first 7 months of the year about how to build a personal credit profile. And you use those things in conjunction to move yourself into a greater place of wealth. So let's get into building business credit. And let me make my screen bigger and let me go here. And if you guys just bear with me 1 second, let me adjust something real quick. Okay. So, as you guys have seen before, this is our contact information for the company. Won't dwell on that too long. I have showed this slide every time I've had a conversation about business credit because I just want to impress upon you all what true business credit looks like. And you'll know it's true business credit because you use your EIN to secure it, not your personal credit. If you're doing a credit application, you will know that it is a business credit application because it will ask for your EIN number first. It may ask for your social security number at some point, but if it asks for your EIN first, then it is business credit you're applying for. If it asks for your social first, then it is personal credit that you're applying for. Remember that you can get business credit without a personal guarantee. There are many business credit lenders that will give you business credit without a personal guarantee. However, many major lenders are looking at your personal credit, or they may be asking you for personal, what you believe is personal credit information, but it may not be because they're trying to make it a personal credit or a personal guarantee lending instrument. It may just be because of the Patriot Act, which was passed in 2001, that requires a lot of lenders to check who the business owner is, and they do that by looking at their social security and date of birth. So just because it asks for the social and the date of birth does not mean you're personally guaranteed. If you're filling out a business credit application, look at the part that says, do you want to personally guarantee this financial instrument? And if you choose to, then you know that they are pulling personal credit. All right. These are the phases that we've talked about in the past. Business legitimacy, making sure your business looks appealing to a lender. Vendor accounts, which would be the equivalent of secured credit cards. These are companies that will give you products and services, sell you products and services, and invoice you for those products and services, and you have to pay the entire invoice at a specified date. Retail accounts, those are major big box retailers that will issue you a business credit card and or a business credit line. And then there are the major business credit cards. So vendor accounts would be the equivalent of secured credit cards. Retail accounts would be the equivalent of unsecured credit cards. And then major credit cards would be the equivalent of small loans. All with the understanding that you're trying to get to major lending for your business, and major lending, loan, credit line, equipment financing. And we're going to go through those in depth in just a minute. But those are the 5 phases to building business credit. And if you work with any credit counseling company that does business credit, they may break those up into smaller steps. We use the 5, and I'm going to talk about the 5th one today. It should be self-explanatory, but Abby, I will continue on and talk about it. So major lending are loans and credit lines that are issued by banks, credit unions, and other lending institutions. Again, when you are applying for major lending, make sure you're applying for business credit lending and not personal credit lending. So an example would be a small business loan as opposed to a small personal loan. And if you are, there are several companies, I won't name them, but there are several companies out there that do credit loans and lines, and they do both personal and business lending. Just make sure you are applying for business. All right. This is very important. Anytime you are applying for lending, applying for credit, applying for credit cards, please ask the lender which credit bureaus they report to. You want them to report to the 3 major business credit bureaus if they can. Sometimes a business won't report at all. Sometimes they will report, but only report to 1 or 2. Sometimes they report to all 3. But you want to ask, because I get this all the time. Abby, I get this from clients all the time. They say, well, I've got business credit. I have a business credit card. And I say to them, is your business credit card reporting to the business credit bureaus? Well, I don't know, but it's a business credit card, so it should be. And I'm saying many lenders do not report to any of the credit bureaus because there's no law that says that they have to. So they don't report to the business credit bureaus. And so here's the deal. You can have a $50,000 credit card, but if it is not reporting to the business credit bureaus, when you walk into a bank to ask for a loan, they don't see that credit card. Many times they don't even see that credit card on your personal side because it's not personally guaranteed, or it only reports on the personal side if you default on it. So Abby, you've got this $50,000 worth of credit. You have been using it wisely. You have $50,000 limit. You've only used 2,500 of it. So it looks great, but it's not reporting. So you don't get the benefit of that. So before you apply, you should ask which business credit bureaus does that loan or credit line report to. And if they don't report to any, ask them if they don't mind. Sometimes, Abby, they will. Okay. Very, very simple. But what I want you to understand is where you can get major lending. Most people think that major lending only comes in 2 or 3 forms. On the business side, most people think that either you get a business credit card, you get a line of credit, or you get a loan. But there are many different types of business credit. We talked about vendor credit. Then again, vendor credit is a creditor that will sell you products and services. They'll send you an invoice, and that invoice will have a net day on it. Net 30 means you have 30 days from the date of invoice to pay. Net 60, you have 60 days, net 90, so forth and so on. That's vendor credit. There's retail credit, which we also talked about in the process. And that is, again, you go into a big box retailer, they may either give you a line of credit or a credit card, or they may give you both. Okay. By the way, it's best to understand when to apply for which type of credit. So let's go back to vendor credit. Well, vendor credit is best used for back office purposes. So let's say you are a construction company. Since Abby's in the real estate space, you have dealt with construction companies quite frequently. Let's say you are a construction company and you are buying supplies and materials to do construction on real estate, but you're also buying supplies and materials to do your accounting, to print out invoices, to have computers. So the best use of vendor credit for you would be to purchase your back office supplies. the things that your admin is going to use to run your business, your computers, your paper, your envelopes. Those are the things, your software. Those are the things that you would want to use vendor credit for. And you want to use a vendor that sells those things. Okay, retail credit, those credit cards and credit lines would be used for specialty needs like your cell phone and small appliances. So if you're in your construction business, I'm going to use construction business for some of this, and I'll use a restaurant for the other things. But if you're in the construction business and you're buying phones for your laborers, it'd be best to use retail credit for that. Or if you're buying, let's say you're buying for the office, you're looking to purchase a coffee machine, retail credit would be the best to use that for. Okay, credit cards are best used for daily, weekly, and monthly purchases like meals, lodging, and entertainment. Can either one of you, Abby, and I know I'm not going to lean too heavily on you, but Siobhan or Abby, can you tell me why you guys think that credit cards would be a great use, meals, lodging, and entertainment would be great to use a credit card for?
I'm thinking about the points that you can gain from using them.
So let me talk about, great answer. So let me talk about points and understanding how businesses work in conjunction. If you haven't started a business, I encourage you to, I almost admonish you to, because it's going to be very, very difficult to move through this economy in the next few years without having a business of some sort, even if you are a gig worker like you're doing Instacart or Uber or any of the other GoPuff or any of the other Amazon gig work out there. It would be great for you to have a business and run everything through your business, because every financial law in this country was made so that businesses could take advantage and consumers would be taken advantage of. Credit cards are a great thing to have in your business because most business credit cards, if not all of them, come with rewards points of some sort. Choose the rewards points that help you live your lifestyle. And here's the great thing about credit cards and rewards points. So most tax laws say that you cannot mix, you cannot commingle business finances with personal finances. For example, you can't use your debit card to go purchase clothing for a party you're going to have for your aunt on Saturday. You could, if you use your business credit card and the IRS does an audit, you could get fined. And in some instances, depending on the dollar amount, there could be some criminal charges brought against you. I didn't come here to spread fear and panic. But the tax laws are really specific about what you can use business cash for. But there are no laws that determine and dictate what you can use business credit points for. So you cannot use your debit card to purchase those clothes, but you can use your rewards points on your business credit card to purchase those clothes. And by the way, business credit cards typically give you 3 to 5 times the amount of points that they would give you on that same card on the personal side. So if you had a personal credit card from a company and it gave you, let's say it gave you 1 point for every dollar you spent on that card as a reward, maybe it's cash back or merchandise rewards. If you had that same card on the business side, it might give you $3 or 3 points or 5 points for every dollar you spend. So your points will accumulate faster and allow you to live lifestyle. You can use business credit points for hotel rooms, rental cars, flying first class. Great thing about these cars is you can, if you're flying and if you fly often, sometimes you have layovers 5, 6, 7 hours, depending on where you're going. Many of those credit cards are attached to lounges in the airports and major airports that give you free meals, free drinks, free bathroom. I mean, it's just, some even have places where you can sleep if you're going to be in the airport for 8 hours or more. And those are at no cost. Now, of course, they cost because you have to spend money on the cards and there are fees associated. But the point is, you get those rewards points and it allows you to use those points at those places. So credit cards are best used for meals, lodging, and entertainment because you spend money on those regularly and you can accumulate those points quickly. Okay, merchant cash advances. Now, I'm not going to use the construction company for this example. In this, I will use a restaurant. So if you're a restaurant owner and you accept credit cards and you batch out your credit cards, let's say they batch out your credit cards at the end of every week. That means, when I say batch out, that means you charge $40,000 a day because you've got an incredible restaurant. So you're charging $40,000 a day on your card, or 50, let's say 50,000, but they don't pay you out that money. You process $50,000 worth of credit cards per day, but they don't pay you that money until 5 days later. So at the end of every 5-day period, you're getting $250,000 worth of credit card processing. A merchant cash advance is great for bridging the gap until you got that payment. So if Monday comes and you're having difficulty meeting payroll, or you want to do some heavy marketing because on Friday, maybe there's a holiday and you want to take advantage of that, but you don't have the revenue generated yet, you can do a merchant cash advance and they will give you the money laying claim to when you get paid out 5 days later. Now, the reason I tell you to use each one of these for its specific purchase, because the companies that specialize in these things are going to give you better terms on these things. So if you go to a bank, for example, and you try to get a loan to cover payroll or to cover this marketing expense, first things first, it could take you, if anyone who's ever applied for a business loan knows that it could take you 30, 60, sometimes 90 days to complete the application. You don't have 90 days for waiting for your loan. Merchant cash advances are really quick. The application process is really quick. You can usually do it within 3 to 5 minutes. And again, they're going to have the best terms, best interest rates, best repayment terms. So use that for that. Credit lines, best used for working capital in businesses that have invoices. So going back to the construction company, you have a contract with the state government. It's going to pay you out $1 million, but it won't pay you for 6 months. You go to a bank, get a line of credit or a credit line to cover your payroll and materials, and then you'll pay back the credit line when you get the check. By the way, the way a credit line works, they will give you a line of credit. They may say $500,000 line of credit. Now you can go in and you can withdraw 25,000, use it for whatever you like. You have to pay the $25,000 back before you can withdraw another 50 or 60. Some of them have flexible terms, which means it's flex lending, which means you can take out multiple lines of credit at the same time. But for the most part, you have to pay back whatever you take out before you can get the next line. Great for construction companies and landscaping companies. Factoring companies. Factoring companies are best used for businesses that have high accounts receivables. So you've got $500,000 worth of accounts receivables over 50 different clients. You can go to a factoring company and a factoring company says, okay, we reasonably expect that you're going to get this $500,000 over time. We will give you a $500,000 credit or a $500,000 check. When you bring in your accounts receivables, we will take that money plus a small bump in interest. which means you're not going to get the 500,000, you're going to get 400,000 when it's all said and done. The reason factoring companies work well is because they typically take over collecting your accounts receivables. So if you're a company that works with accounts receivables and you're having difficulty getting your money, maybe you issued an invoice and you're expecting to get paid in 30 days, but on average you're getting paid in 60 days. Well, you go to a factoring company, borrow the money, and then the factoring company steps in and they work to get the money back because the money is going to come directly to them. So now they're going to increase your accounts receivable turnover by 30 days, or at least decrease the amount of time that it takes to get paid. So factoring companies are great to work with. Micro lending. Micro lending is great for a quick injection of capital. So you're getting a loan from a bank, but it is a bank that specializes in loans that are $50,000 or less. And they have, again, the application process is very streamlined and it's quick. You can get a quick injection of capital, usually for things like marketing or an office upgrade. If you are a lawyer and you want to upgrade your office because you are getting ready to take on corporate clients, a microloan might be a great way to go. If you are a company that's doing, you need to do some marketing like my company is doing right now, a microloan we're not doing a microloan, but we want a quick injection of capital. And so we may look at a micro lending company to get that injection. Equipment financing, self-explanatory. If you have equipment, restaurants, construction companies, and you need to purchase more or upgrade, equipment financing is best. Again, really quick and specialize in better terms for equipment financing. You go to a bank to get a loan to fix your equipment, they're going to ask you to describe all the equipment. How long have you had it? You'll go through all of that. The equipment financing company is just looking at the capital expenditures and the depreciation to determine what they're going to give you. Okay, loans. Loans are best used for major financing. You want to grow. You want $100,000 to put into your business because you need to pay a salesperson who's going to generate revenue, but they're not going to generate revenue for a few months. You're going to get a loan to pay their salary. Maybe you pay them a year's worth of salary, and then you're expecting to get that money back over time. Loans are great for that. And then real estate lending. Don't try to do a business loan to purchase real estate. Instead, do a real estate-based loan. So you want to buy your office. You're leasing space from a landlord who has several other companies in the building. The landlord says, I want to retire and move to Boca Raton. I'm selling the building. I'm going to give you the first right of refusal. Don't try to go get a business loan. Instead, get a real estate-based loan, because real estate-based loans typically use the value of the property to determine the lending, and they are better equipped to provide that lending. So those are the types of major lending products that are out there, and you can now understand what those products are used for. You can use them in conjunction for your company, but I encourage you to make sure that you research which one of these you really need, when you really need it, and then go to the appropriate lending institution to get it. Thank you, guys. That is my time. I have enjoyed this entire 2023. I see Abby has her hand up. Please, question, comment.
It's such a wonderful information, Kevin. I wanted to know if you can give us an example, perhaps, of a good instance of which you would use one of these to pay off another one. Is there a good situation when you should take one and to pay off another for business, and also give us a bad instance in which you would never use this to pay off that?
Sure. Good. Great question. I try to I try to impress upon people, don't use debt to pay debt. There is rarely an instance where you taking on more debt to pay debt is good. However, there are several instances where you may have no choice. Here are some, here are some of them. Interest rates. So if you have a business credit card and it has a 26% interest rate, and there's another credit card that is wooing you, they send you an application and say, we'll do a balance transfer. Let's say it's a $10,000 limit on the credit card. You've maxed it out because you're running your business, running it well. By the way, ladies and gentlemen, there is a such thing as good debt. So if you take on a $10,000 credit card and it has a 26% interest rate and you max it out, but what you spent the money on generates 40% worth of revenue or 40% worth of net profit, then that is called good debt. As long as you apply the excess, your net profit, back to the card, meaning you pay the card off. But let's say you maxed your card out, it's 26%, you've maxed your card out, and you got solicitation in the mail that says we can do a balance transfer for all 10,000 of that at 0% interest for 12 months. That is an instance where I would take one debt instrument to pay off the other. You balance transfer, now you're not paying any interest on that, and now your 40% interest that you are gaining from that, you can pay back that new card and looks great on your credit. Another instance is if you took a loan to pay off your credit card. So same credit card, 26% interest rate. You decided that you were going to get a business loan anyway, include in the loan all of the credit card debt that you have, and use that loan to pay off that credit card debt, provided the loan interest rate is less than less than the average credit card interest. So if you have 10 cards, one of them has a 2% interest rate, but one of them has a 26% interest rate, keep in mind, if you get a loan for 14%, although it looks great on the card that has a 26% interest rate, it looks terrible to the one that has 14%. So add up all the interest rate on all of the cards that you plan to pay off, divide them by the number of cards, and then you can determine if the average amount of debt that you're carrying is more interest or less interest than the loan. So if you add them all up, they equal 20%. You get a loan that's 14%, then that's a great place to transfer debt. The other place that I would transfer debt is real estate-based lending. So you've got $100,000 worth of debt, whether it's retail credit cards, or credit lines or loans. You got $100,000. You find again, your landlord is selling the building. The minute you purchase it and close out, that building is going to have $450,000 worth of equity in it. You take out an equity line of credit on that building, you pay back all of your debts, and now you just have the debt on that building itself, potentially or probably at a much lower interest rate than what you're paying on those other things combined. That was a long-winded and comprehensive explanation. Did I answer the question?
Yes, you did. I thought that was something that perhaps our viewers would be interested in knowing because we're very familiar with moving funds around. And so we can see that we can also do that even in the business lending world. Thank you so much, Kevin.
Yeah, it's creative financing. We do create creative financing as small business owners, and so Shifting debt,
Shifting debt.
shifting debt,
Love it.
shifting debt.
Thank
So if there are no other questions, I'm going to shift over to
you.
uh, I'm going to shift over to my great friend, colleague, Abigail Bridgeford, who is
Who is going to try to follow a hard act? It's a hard act to follow, yes. So, in line with Kevin's presentation today, we felt that we pick a subject that pairs well with it, which is mixed use properties. Um, Over the years, a lot of our clients have come to us and they basically wanted to have an idea as to what they can do with their portfolios and an interest to try to obtain and to increase capital. And one of the things that I like to recommend mostly is a mixed use property. Um, so for those of us who may not be as versed in this space, because you know we don't expect everyone to be real estate professionals, we're going to talk about what is a mixed use property. And some people may say, well, it sounds exactly like what it looks like, sounds like a mixed use property. Okay. Well, there's some truth to that. However, let me just make my screen a little bit bigger here so I can see all of you. In that way, if there's anybody have any questions, I can address those things as well. So we highlight in this sentence commercial because a mixed use property generally is a commercial property that includes commercial and residential space. But I highlighted commercial because in a mixed use property, we want to have some element of that property designed for earning income. So we use an example here as a condominium in a shopping mall. So you can have, and I'm so sure many of you have seen, we may have a giant condominium, and in the condominium, there may be a section of that building that's used for shopping. We have some very popular stores there, but maybe most of the building is a condo. So you have people who actually own or live in these properties, and then there's a section of that building, which would be one building or a group of buildings, and that's designed for retail space. So in that instance, it would be considered mixed use. So why we're going to have this discussion is because we're going to pick each element of the mixed use building so that you can see for yourself if any of these type of situations or scenarios will work best for you in your situation. So on the residential end, people say, well, what's residential? What do you consider residential? First and foremost, yes, as Kevin alluded to earlier, all of us have basic needs, and residential or shelter is one of the greatest, if not the greatest need that we all have. No one wants to be on the street. However, for purposes for financing, so an appraiser generally will go into a building and he or she are looking to see if the building is going to be used for what an applicant applied for. So what we normally do is we take the space and we look and see, okay, is this somewhere a person can actually live in? Now, we're not trying to be facetious, but some people have chosen places of dwellings that are not what's considered adequate for financing purposes. And so we just generally want to make certain that for this conversation, we're looking at places that has heat, plumbing, electric, all these things that was considered residential, our basic needs. We need to be warm, we want to make sure we have everything, our appliances and things in good working order. We want to be in a position where a lender will not feel that loaning their money will be a waste, and they're concerned about our personal safety. So let me go back for a quick second, just one moment. On the residential side, these photos here, these are things that we all are very familiar with. You have row houses, you have duplexes, you have single homes, you have triplexes, quadruplexes. So for the purposes of residential, I just want to also reiterate that we're looking at anything that's 1 to 4 units. So that's considered residential. Once we get past 4 units, then it's considered commercial. But the unique thing about this is that as it becomes mixed use, which is the theme of our subject, then you can have a single home and some commercial elements, even though it's less than 4 units. So you can have in Philadelphia, we're very familiar with storefronts where you go to mom and poppy stores. So on the first floor, you go to the store, but then there may be a family or families living on the second floor. So that's a mixed use building. Someone lives upstairs, and then there's a store being operated on the first floor. So that particular building would not be necessarily called residential building. It's a mixed use building with the residential element. So I just want to make sure I mention that. So on the commercial side, now commercial, we look at the root word, commerce. So we're talking about a building that is designed for us to make money off of. And, in general, we talked about a store, strip mall, and office buildings. And all of these buildings are different in some way, form, or fashion. A store, as we mentioned, you can go to a corner store, poppy store, and you just go in there and conduct perhaps and usually buying something or taking care of one means of business. Whereas the strip mall, you may find that there's going to be a collaboration of stores all along, a parking lot. Usually you drive in and it's a mall of some sort. And we have all these cars outside parked, and people pick what store they want to go to. I don't know, Kevin, you might favor what's one of your favorite stores? Or I'm gonna say you might be a what Bosco?
Express Men. That's my favorite store.
Oh,
Express Men's.
Express Men. All right. All right. Well, I'm going to probably be next door at a Macy's or something. But within the strip malls, you'll find that it's usually a really big chain store that's kind of like everything's all around that, whether it's a Home Depot or Walmart, and then you have all these little stores around there. So those are commercials. And then of course we're very familiar with office buildings. These are just buildings that specifically made were usually white collar and some blue collar workers, but basically they're designed to, like, whether it's your hospital, like your doctors, your clinics, tax preparers, um, these are the type of professions or medical professions and things that you use. So on a commercial level, there's a lot of different types or forms of commercialism, whether it's going to be in a small store, a strip mall, or even office buildings. But usually you'll find that there's a collaboration of them all. And what we're looking for when it comes to if we're going to pair the financing element with these types of buildings, we're going to start looking. Let's talk about some of the things that we're going to be looking for. So with these types of buildings, what we had discussed earlier on in the year is we talked a lot about the residential point, where we're used to 3.5% down payment FHA, or 5 or 10% down for conventional financing. Generally, in a mixed use building, you're going to need a minimum of 25% down. Now, it's actually financed more on a commercial side, but using the residential element to determine your ability to pay back the loan. So, to make it more simple, if you have a building that has a store and then an apartment on top of the store, and you would want to get financing for that store, the bank will want you to put 25% down because it has a store. Okay. But they also want to know, what is that apartment upstairs renting out for? So if that apartment, let's just say for illustrated purposes, is renting out for $2,000 a month, they're going to take that $2,000 and say, okay, All right. So this property is already earning 24,000 a year because you're taking the 2,000 times 12. And it's saying, okay, so you're getting 24,000. And so they're going to factor in that revenue and they're going to say, okay, we'll loan you, let's just say 300, $400,000 because we see that the property has the potential already to earn a certain amount of money. But then at the same time, we want to see that in case your tenant moves out or in case this store ends up moving, because we don't, based on their current rent, they want you to invest 25%. So your financing is going to be more astronomical when it comes to renting or getting a business or a building that's a mixed use building. Another element is a little bit different too when it comes to strip malls or even these other bigger establishments is they may require, oh, I'm sorry, we got a question. Okay, Kevin, let's see what your question is. How can I help you?
Abby, I stopped you. I raised my hand in the middle of your statement. Can you finish making your statement and then I'll ask my question?
Okay, well, you know I'm getting old, so let me see what was I about to say.
Zoning. You were talking about zoning.
Okay, all right. So when you have storefronts and when you have strip malls and when you have these bigger types of leases, you know, they have their leasing factors are somewhat different because people generally lease for a longer period of time. For instance, McDonald's usually leases their places for 100 years. You might think, what? Because buildings or companies like that, they don't expect to ever go out of business. They expect to always be where they are. So you can have a 6 month lease, you can have a year lease, you can have 5 year lease, 10 year lease, 20 year lease. So your down payment could possibly come as a result of a percentage of what that lease amount would be. Similar to what we're used to when you're used to a security deposit, you put first month security, last month security or deposit, and then the current month as to get your foot in the door. Well, some of these strip malls are very similar. They may require for you to pay a whole year of your leasing up front before you move into their building. And then I'll tell you why. You, how often have you seen buildings when you walk down the street and it's vacant? Big old sign on the front that says lease, and they tell you the square footage of the lease and how much per square feet. And it's been vacant for a long time. You might see months or years of it being vacant. So oftentimes these types of companies will require a good amount or a really big amount or a great percentage of the annual or the leasing period up front. So Kevin, may I please, I'd like to address your question.
Perfect. So, Abby, if I purchased a building,
Yes.
I'm going to use small numbers just to illustrate. So, if I purchased the building at $100,000 and it already had tenants in it,
Mm-hmm.
and the revenues that building were generating were $200,000. Am I having to pay a down payment of the 100,000? The 20, so 20, am I paying 25% of the 100,000, which is what it's going to cost me to acquire, or the 200,000, which is what the real value of that property is?
Knows what you're purchasing it for. So thank you for that. That's a very good question. I'm sorry. Whatever your acquisition cost. So if you and a seller agreed to sell this building for $100,000, obviously the cap rate on that property is going to be significantly more than that if you're already, as you mentioned, if the property has the ability to generate revenues of twice as much. But the lender is looking for is they want to see that it's not going to be a risk to them. And so what will help you is if you have a property that is already generating revenue. So if that same building was empty and say it's vacant, and so you buying it for $100,000, the lender may ask you for more than 25% down because of it being vacant. Because they want to know how you're going to pay this back. this building is supposed to be a commercial building, and it's right now not demonstrating that it has the ability to pay itself back. And you can go to a lender, and Kevin, you tell the lender, give you a business plan and tell them what these great ideas you have for this building. And the bank has to be able to see for somehow, some way to protect their interest that they're going to get their money back. Because how often people have plans and some of their plans unfortunately don't go the way they had hoped. So you can have a building, it can be vacant and you still can get a loan, but it can also affect your interest rate, your down payment. And if you find a building that's currently bringing in rents now, because the converse can happen too. I had it happen with one of my value clients was buying a property and the rent was $1,000 a month. He was renting to a family member, so the family member wasn't paying as much rent. But the monthly payment based on the sale price would have been $1,400 a month. So that means then, according to the bank, you're at a $400 deficit each month. And so the bank is like, well, so why should we loan you this money? Because based on what the property is currently renting at and what you're buying it for, you're going in at a negative at 400. Now the owner didn't mind that so much because they knew that once their family member moved out, they would be able to rent that unit for 1,400 a month. So then in that case, the owner was willing to absorb the difference and had to pay, I believe, 30% down on the sale price to bring that payment within the thousand that the current tenant was actually paying. So
Go ahead.
no, just in using that illustration too, I don't want the audience in general to think that it's you that you as a buyer is not a negative thing so much all the time when you have to put more down. I want you for this purpose, for our purposes of our conversation, look at it as equity. Your down payment is your equity. It's what your initial investment is in the building. So since we're discussing financing of remember, we're talking about mixed use buildings. One part, if not the whole building, is going to generate some type of revenue for you. And if we go with what Kevin discussed about lending, if your situation ever so gets difficult because you did put 25% or 30% or whatever percentage that the bank required of you at the time when you acquired a property, you can take a line of credit or a loan out and do, like Kevin mentioned, it's the real estate lending and take that money back. So don't ever look at it as, oh, wow, I had to come out of my pocket all this money. It may seem that way initially, yes. But remember, we're trying to acquire something that's going to ultimately provide us, hopefully, with a positive cash flow. That's the goal, right?
Yeah. So staying with that example, changing it just slightly, you find the building, they want to sell for 100,000. It's vacant, but it needs $100,000 worth of rehab.
Mm-hmm.
Once it's done, then the revenues generated will be 200,000 per year.
Mm-hmm.
So you're paying the 25% of the acquisition plus the rehab costs, right?
Well, your rehab costs may not necessarily be, it's factored, but you're not paying it. You're not paying it until you do the rehab. So if you're taking out a loan that will allow you, are you financing the rehab? I guess that's my question. Or is that what you're asking?
So I'm asking, yes, I'm asking what happens if you need $200,000, 100,000 of it as acquisition, 100,000 is rehab. So you're taking out a $200,000 loan, you're paying 25% of the 200,000, not the
Mhm.
25% of the 100,000.
Right. Because you're borrowing, since you're borrowing the 200,000, yes, you're putting 25% of the 200,000.
So
Anything that you're borrowing, the bank is going to
make
ask you,
sure
but
that those two things are in commercial lending don't go, they're not separate.
nope, nope. Because with commercial lending, when they go to foreclose, they take in, it's just like with a residential, They look at how much money they loaned you. Now, what you used it for, now that's where it gets a little more gray areas because some people don't actually use the funds for what they borrowed it for. They may say, I want to put a new kitchen in my restaurant and maybe has some type of medical emergency, and that new kitchen never got put installed in the restaurant. Well, the bank is not going, well, we just want the money that we loaned you for the kitchen because that you didn't use it for that. No, they're going to want it's a composite. Now you can do a lending, like if like you mentioned earlier, if you want to finance something specific, such as a kitchen, then that loan will be separate than the acquisition loan. So we're discussing now if you're buying a property, there are loans that you can get, rehab loans. You can get the whole, you can base a loan on the fair market value after the property has been completely rehabbed. You can do a loan for that if that's what you're asking for mixed use building. Those are commercial loans, and then those commercial loans, I will tell you, they will look at everything. They will look at all your bank statements, your W-2s, your tax returns for like 3 to 5 years. They're going to be really looking and delving into your numbers and your ability to repay, especially when it gets over $500,000. So, very good questions, though, by the way. So, when we talk about zoning, I'm not going to spend a lot of time on it because I do want to respect everyone's time. But please, I put one note here is to verify prior to rental or purchase because you may buy a mixed use building thinking that because it's a store that you can use it for anything. You might want to put a daycare, you might want to put a hairdresser, you might want to put a real estate office, you may want to put a credit counseling office, whatever it might be, tax office, whatever it might be, but the zoning for that building may not allow that. And actually, we just had at our triple play, our real estate convention, we just had a woman tell us this a horror story. They bought a building and it was in a strip mall, so it's an area that had misused buildings, and she went and put a they was putting a bank there in the building. But when the title came back, long story short, the title came back and that was one of the prohibited uses of that building. And the reason why was because another bank on in the strip mall has something on the title that prevented any other financing companies to be in that area to prevent competition. So I just thought that that was interesting that it got so far along and no one, they let that transaction go that far along. And then after you put the building there, happen not to be able to use it for what you bought it for. So it's important that even though it's mixed use, find out what it can be used for before you buy it. And that takes just sometimes a matter of making a phone call, checking out with the ordinances and also the areas in the, if whether the counties or whatever in areas that you're looking to purchase real estate. So we're going to talk about on the residential side, what you should look for it to be even considered residential. Does the rooms have closets, the bedrooms? Because that's on because it's not considered a bedroom if it doesn't have a closet and if it doesn't have windows. So some people have office spaces on the first floor of a building and they actually make them and use them as bedrooms. That's illegal because you have no way, if there's a fire, there's only one way out. And what if the fire is there in the hallway? And that's the only way out because there's no other windows. So please, for residential purposes, if you're buying something and you want someone to live in it as their dwelling, make sure that the bedrooms have closets and windows. Now, when we talk about water sprinklers and fire alarm services, those things are what's required on the commercial side. So if you have a building that has more, now this is where it gets a little tricky. Here in Philadelphia, as of late, they changed it to 3 units, which we already discussed. 3 units doesn't make it commercial. But because there's 3 families there, they're requiring now the alarm systems and the sprinkler units. But generally speaking, it's required across the board for all commercial spaces. So if you have a building that you're using for business, and even if it's a small office space, it's going to be highly recommended that you have water sprinklers and a fire alarm service. And the fire alarm service is not just, something you just pull the lever down and it says it's fire. It's something that will contact the local ordinances, the fire departments, the police departments, in the event there is a fire. So that service, or so that you can get prompt attention to whatever the matter might be. So there's a lot of information that we talked about today, but if you have any questions, our office, or we're here to help you sell your mixed use property. And we're going to just take a moment, if I can, Kevin, just to thank everybody who's ever joined us, who's ever spent any time with us, whether you asked a question, whether you came in person, whether you logged in on Zoom. Just want to tell you all the things that we at Genuine Property Solutions Real Estate had a chance to discuss over the past year. We went from the pre-qualification, how to choose a real estate agent, real estate terminology. That was fun because we played a couple of games with that. And then in August, Kevin was so gracious to spend the whole hour or so helping us talk about business credit, which is something he's very passionate about. And when we think about even these past 3 months, we might remember more of our business segments, and about investing and estate planning and today mixed use property. So we've talked about a great amount of information in over the past year. And so in behalf of Kevin and myself, we don't know what 2024 will bring, but we still will bring you very valuable information. And we really thank you so much for attending. And if there's any questions, we'll see you next year.